Hello everyone. Today we're going to talk about value investing. In the late half of 2020, there was a shift in the market. Suddenly, after a long and painful decade, value stocks started outperforming growth stocks again. Now, this left many investors questioning whether it's time to get back on the growth bandwagon. In this interview, we'll dive into this topic with Hans-Kristian Sjöholm, who oversees our global equities team. Hans-Kristian is an advocate of fundamental, research-based value investing. Welcome, Hans-Kristian.
Thank you.
So after a rocky decade, value stocks seem to be making a comeback. The turning point seems to be somewhere in the latter half of 2020. Can you tell us what happened?
Well, I would argue that short-term market moves are primarily driven by narratives, simply because, people aren't able to forecast the future, so we keep on guessing and creating arguments for our guesses, and then some of these stories simply catch on in the markets and create feedback loops and momentum. But these narratives can change very quickly as well, and that's why stock markets are essentially unpredictable. Going into 2020, a lot of assets were already very expensive and highly speculative. And then in 2020, a story was starting going around saying that basically technology is going to dominate the world. And a lot of traditional industries and restaurants and airlines and value stocks are going bankrupt. Then people probably had some time to reflect. There was some government measures taken, and then we had the vaccines, and the story changed.
Yes.
So suddenly people were saying that, okay, probably there's something more to life than technology. I still want to see my friends and travel, and these value stocks are not all going bankrupt. Actually, they are going concerns with earnings and assets, and we should treat them as such. And I think that kind of set off a trend change in favor of value, which was followed by more narratives like, inflation and interest rate, how they support value stocks and might punish growth stocks. And there is, of course, some truth to that based on the concept of a nominal government bond.
Yeah.
But in a company or in the valuation of a stock, there, of course, are many moving parts. Okay. And it's not as simple as we are led to believe. But here we are 2.5 years later with value outperformance.
Yeah. So looking forward, how do you see the performance of value versus growth? Is growth cheap now that some air has been let out, or can value keep outperforming?
Well, academically speaking, if value are cheap stocks with low valuation multiples and growth have high valuation multiples, the long-term historical track record of value is very impressive. So I'm always comfortable holding a lot of value stocks instead of, expensive glamour stocks. Yeah. That makes more logical sense to me. And I think that the 2010s was more of an exception than the new normal. Yeah. Looking more midterm, there's some air out of the growth stock sector. And a lot of people have already lost a lot of money. So some people maybe have lost 70%, others maybe 100% if they were involved in bankruptcies, scandals or frauds. And that changes behavior. These people are disappointed, it changes the attitudes, it increases risk aversion. Now people even think about, diversifying banking deposits.
Yeah.
And it will take time before these people return to speculative activities, and I think many of them never will. So with that trend change and the value spread between growth and value stocks still extremely high on some measures, I think there should be a lot of mean reversion in favor of value stocks before we can, call the environment anything close to normal.
Yeah.
And that makes me more optimistic than usual on value investing. It could be a historic opportunity.
Yeah. So sounds like there's a paradigm shift that has happened, and how do you see this in the broader economy and in company behavior?
Well, when attitudes change, risk aversion increases, we have inflation, we have a positive price to money in the form of positive interest rates. Capital allocation decisions within firms need to change. There's no free money. And you have to have more cost control as well. But also within the investment community, people are putting more emphasis on free cash flow, on less debt, because a lot of debt is of course not very attractive in this environment. And also when you look at cost control, technology companies have been expanding. They aren't masters of cost control, at least some of them. And this is a new environment with a lot of adjustments needed and probably some companies going bust.
Yeah.
Whereas in traditional sectors, at least in some stocks, you can find companies that have been fighting deflationary forces and Chinese competition for 1 or 2 decades. They have been masters of capital allocation just to survive, and currently they are seeing their selling prices increasing instead of decreasing or being flat. So these practices they have already been doing for a long time are very valuable now. Last but not least, looking at government policy, you want to kind of protect the small guy, and you want to protect healthy businesses that create new cash flows.
Yeah.
You don't want to kind of support financial engineering. You don't want to support business models that take leverage just to leverage up old cash flows, like let's say in leveraged buyouts or share buybacks or taking debt to leverage up commercial real estate. Instead, you try to solve stuff like the climate crisis or the healthcare crisis or the national security crisis or income equality crisis or deglobalization by helping other sectors.
Yeah.
And a lot of those sectors are traditional sectors. You know, we need a lot of energy assets, a lot of manufacturing capacity. So, you know, we need materials, we need machinery, we need chip fabrication plants, and many of these companies actually reside also in the value segment of the market currently.
So it sounds like there's an opportunity in value stocks. What steps do investors need to take to make the most of it?
Yeah, I covered it to some extent already, but you know, let's take inflation when costs are going up and the price of your property, plant and equipment is going up. There will be a lot of companies that find that the internally generated cash flow will be swallowed up just to produce the same volume as before. So there will be no money left for, you know, paying dividends or for growth capex. And you should avoid this type of companies. So it's very important to focus on companies that are able to convert earnings into good old-fashioned, you know, no strings attached cash flow.
Yeah. So the takeaway is that the recent trend favoring value over growth is a reflection of a broader shift in the market towards valuation discipline and fundamentals in general. Thank you, Hans-Kristian, for sharing your insights and expertise with us today. And we hope you found this discussion helpful in navigating today's complex situation. This is Evely. Thanks for watching.